Welcome to RIA Match's webinar, How to Finance Acquisition and Succession. I'm Mary Ann Buchanan, founder and CEO of RIA Match. Thank you for joining us today. In addition to advisors and firm owners in our audience, we have a number of industry leaders. We have a significant number of you who have, that are even in attendance here today, and that really validates the importance of this topic. Obtaining financing for acquisition succession is a critical element for our industry's future health and growth. We want you to be part of the discussion today. Thank you for coming. Let me cover some quick housekeeping for the group. First, let's do an audio check. Raise your hand if you can hear me. Do you see over on the right where you can raise your hand in the panel? There we go. Joel, Forrest, Darren. Oh, we've got lots of hands going up. Mark, thank you very much. Michelle, good deal. Okay. So your line should be muted, so you don't need to worry about that. That's automatically done with a webinar. We want to let you know that the webinar is being recorded, and it'll be up on the RIA Match site by tomorrow. We've gotten some emails and a number of people who were unable to join us today. So be sure and let your colleagues know that the session's recorded and that they can listen to it at their convenience. Okay, how will we take questions? We will take questions in the chat box in the panel there on the right. Just type the question when you think of them, and we'll answer them at the end. We'll circle back around. Any questions that we don't get answered, we'll include in the Ask the Panel section of the RIA Match website. We'll also include the questions that are answered. So be sure to keep your questions general, anonymous, and high level. So let's go ahead and test our chat box. Everyone type into your chat box the city you're calling from. Okay, let's see. Thank you. Can you hear my voice now? I understood my voice was breaking off a little bit. There we go. Chicago, Davis, California, Omaha, Philadelphia, New York, Wilmington. Wonderful. Great. So you can see there the North Pole. Okay, Tony, that was pretty funny. So you can see we can... that's exactly where you'll come in to do your questions. Now, we'll be conducting polling during the webinar, and we'll share the results with you as we go along, and that should be insightful. Okay, so we're done with housekeeping. Thank you very much again for coming. We trust you'll gain valuable information, and we hope you enjoy the webinar today. So very briefly, let me just introduce you to RIA Match. RIA Match is a website that offers financial advisors solutions for succession planning and growth. The website matches advisors and firms with other advisors and firms who want to buy, sell, merge, or join practices. The advisors and RIAs can search for free and pay to connect anonymously and securely. RIA Match is independently owned, and our mission is to create an efficient market for advisors and RIAs to partner their practice. The site is agnostic as a custodial platform. We created the playing field. We don't call the plays and we don't benefit from them. It's designed to serve all advisors, regardless of scale, scope, or experience. Success on RIA Match is making connections that will lead to potential partnerships or new firms to join. Our goal is to bring advisors the most efficient tools and excellent information so you can make the best decisions for the succession and growth of your firm. We just celebrated our first year of service to the community. We have over 1,200 registered profiles on our site, and those profiles have sent over 7,000 communications between them. So let's get started. Today we'd like to focus on how to finance acquisition and internal succession. First, we'll start with a big picture, looking at the deal environment. And then we'll look at how Live Oak Bank participates in investment advisory lending. Next, we'll look at a case study from an advisor who's just completed an internal succession. So let me introduce our panel of experts that have joined us. Dave, thanks for being here. Dave is founder and managing partner of DeVoe and Company. Previously, he served as managing director of strategic business development at Charles Schwab Advisor Services. In that role, he developed and led Schwab's transition planning platform, which provides comprehensive M&A and succession planning services to registered investment advisors. During this 8-year period, he provided strategic counsel to over 300 advisors. Jason, welcome. Jason is Managing Director of the RIA lending vertical at Live Oak Bank. As a former manager of a multi-million-dollar advisory lending program at Schwab, Jason is an expert lending to this industry. Jason has held several strategic roles within large banking and financial institutions, designing, developing, and executing lending programs. Debbie, thank you for being here. Debbie Claydon is the owner of Carpenter Claydon Advisors in Orlando, Florida. CCA is a fee-only RIA with $150 million of AUM. Debbie began her career with Dean Witter and then worked for Barnett Investments. 15 years ago, she left the brokerage side and formed CCA with Keith Carpenter. The firm's services include investment advisement and financial planning, as well as fiduciary consulting to retirement plans. About half the practice consists of high net worth individuals and the other half retirement plans. Debbie was 40% owner of the practice before buying out her partner. And I'll be moderator today. What I'd like to do is to share with you the results of the questions you answered when you registered for the webinar. What types of firms are participating in this webinar? 27% of you, first off, let me back up. Actually, 15% of those in attendance service our industry. So this really shows you that this is an important issue for all of us. So then you take that 15% to the side, and the remainder, so of that group who are actually advisors, 27% are early solo practitioners, 16% mature solo practitioners, 19% early ensemble firms, 24% mature ensemble firms, and 14% market dominators. Okay. Let's take a look. We asked a couple of other questions. The first one was how many of you had actually bought or sold a practice? So of those that are advisors, a third have either bought or sold a firm. Now we asked a second question, which had to do with lack of access to capital. And the next question was, has lack of access to financing been a barrier to completing an acquisition or succession for you? Now, 40% of you answered yes to this yes-no question, but as we reviewed it, we realized we didn't offer the answer that I have not attempted to access financing. So, as luck will have it, we will launch that as our first polling question. So, because we suspect that this has skewed our numbers and giving us more no's than is accurate. So, we'll redo that in just a minute. So, let's begin our panel discussion. We will focus on 4 main elements: the industry trends in M&A deals, who's getting deals done and how, trends and data from Live Oak Bank's advisory lending. And then we'll look at an acquisition case study, how a buyer addressed her challenges and completed her transaction. And then we'll look at Live Oak Bank's lending methodology as well. So the first thing we'll do is we will start with that polling question that I just mentioned. Let's get that going. Okay. And here you go. Just one sec. There you are. Has lack of access to financing been a barrier to you completing an acquisition or succession? So yes, no, and have not attempted to access financing. So if you would just put us as your front screen for just one second. I realize that many of you have more than one window open. And we'll give you just a minute to go ahead and answer this. This is really very helpful for us in understanding how we can better service the community. So we will give it another 20 seconds or so. 64% of you have voted. Thank you very much for taking the time to go ahead and vote. Okay. All right, we're going to close the polls here. in just a second. 72% of you have voted. All right, great. Thank you very much. So, of those that have voted, 25% of you said yes. Financing has been, attempting to access financing has been a barrier. 15% said no, and 60% have not attempted to access financing. So I'm really glad that we relaunched that question, because that gives us a better sense of where we are. So Dave, let's start with you. What's your thought on attempting to access financing? What's your thought on this polling question?
Yeah, Marianne, thank you. Yeah, it'd be interesting to know of that percentage that has not accessed it, how many of those have actually attempted to execute a succession or an acquisition. But if we look at the data, I mean, after 10 years of doing this, literally talking to hundreds of advisors, access to capital is an issue, and it has been an issue. While I was at Schwab, one of the first things that I did when I launched their transition planning platform was to go out and try to find different sources to finance these transactions, both internal and external. And it's a challenge because most banks are looking for a secondary source of repayment. Essentially, they want inventory or machinery that can be sold if the loan goes bad. And for our industry, we just don't have that. So it's a challenge. SBA loans have more flexibility. Granted, they have some constraints around the types of loans that they're appropriate for. They have more flexibility, but historically it's been an arduous process to get an SBA loan, and I think Jason will talk to that briefly as well, and how their company is a little different. But for advisors, especially those that want to buy into a larger organization, or they want to acquire an organization outside of the money they have in their pockets and in the couch, financing is important, but it can be a challenge.
Right, right. Well, Dave, we look to you to give us sort of a window into the M&A deal landscape. What does that look like right now?
Yeah, I think I expect folks on the phone are curious not only about succession planning trends, but also M&A trends. We have much better data on M&A trends, and you can see it in the slide here momentarily that mergers and acquisitions has increased over time. And Marianne, are you able to pull that up again?
I'm having a little technical difficulty. Isn't that just lovely? Sorry, okay. You're all looking at my email. I apologize.
That's
I will.
Okay. I'll describe it.
All righty. So, it was there just a minute ago.
Absolutely. It'll be back momentarily. So, the team that I used to oversee at Schwab has tracked M&A data from 2003. They continue to do it today as well. And the key things I want to focus on in this chart are the green bars. And essentially that's the number of transactions that are executed every year, industry-wide, for firms with $100 million or more in assets under management. And the reason that the team tracks deals with $100 million plus is there's just a lot of clarity on those transactions. If it's less than $100 million, it's just harder to get that data, and consequently the data could be a little more skewed. So what you see is this upward trend from, I think we have data that goes back to 2002, even 2001. There's a strong upward trajectory through 2008, year-over-year increases in mergers and acquisitions. And I think everyone on the phone can imagine what happened in 2008. We had that stock market crash, which not only put a lot of downward pressure on assets, revenues, profitability, but ultimately valuation. It also became a huge distraction for advisors. It was much more important for them to pay attention to their clients, make sure their clients didn't make the wrong decisions, as opposed to negotiate that deal. So since 2008, you've seen that decline continued through 2009. In 2010, folks started coming back to the tables, and that's why we had that spring coil in there with a record of 70 deals. The last 2 to 3 years have been a little choppy, and there's not a great data point or a great reason for that. The market has been challenging. The macroeconomic situation isn't great. 2013 I anticipate to be stronger than 2012. Q3 was likely to be one of the strongest quarters we've had for over a year. So the market could be coming back. I think is when I dust off the crystal ball and I look into the future, I expect a continued increase in mergers and acquisitions. And that's driven by a number of factors. The key one is the demographics. As folks move toward retirement, they need to sell their business. And based on my calculations, we're going to need to see hundreds of transactions a year to clear, for an industry that has tens of thousands of firms. The other key drivers are the proliferation of consolidators, firms like Focus Financial Partners, United Capital, even organizations like Beacon Wealth or Experian, which are RIAs that have been built out in the M&A business. These organizations have great traction, and they're likely to continue to do so. And that category I just mentioned, the Beacon Points and Experience, amongst others, are some examples of the growing sophistication of RIAs. RIAs are doing more and more transactions. They're the buyer in a growing dominant category for acquisitions in this space. So that growing sophistication of advisors like everyone on the phone who are using not only acquisitions to achieve growth goals, but also to achieve other strategic goals and objectives. Those are the key trends that are likely to drive mergers and acquisitions for years to come.
Oh, that's very insightful, Dave, and I really appreciate the outlook there. I think that you're right. I think that there are a number of firms that have become sophisticated, and as they grow their practice, their firms, their businesses, they're able to grow and scale, and others can benefit from that. Not only that, the technology allows smaller firms to consolidate and still be somewhat small, not just a big aggregator, but you can have small firms doing very well with the technology that's available. Jason, I wanted to turn to you for just one sec. What kind of time frame should an advisor allow to source and complete financing? What would you give them?
Yeah, thanks, Marianne. We're averaging right around 30 days right now, and that's from an initial call to funding and writing the check.
Wow.
We've expedited that in as-needed cases. We can do it. The quickest we've done is about 15 days. But really it depends on the deal, whether it's, and as we're talking more merger and acquisition or internal succession, we really try to manage the client expectations. And there's other things that go on that are kind of outside of any financer's realm of control, things like valuation, things like buy-sell agreements and things like that have to be executed. But that 30 days is really from that initial call through funding. In our world, it really narrows down to two things. Our clients want to know, are they approved, and when do I get my money?
Right.
Are they approved as a result of our credit decision, underwriting's complete, and our credit officer has kind of done the stamp and said they're approved. That means we send a commitment letter that's legal and binding by the bank. That typically happens in about 10 business days. And then, as I said, there's a few outliers like valuation reports and things that just have to get done in order prior to funding the actual loan. The transaction needs to get done if it's a buy-sell type of an acquisition or an internal buy-sell that's associated with that as well. So really it's around 10 days or so for that am I approved, and it's around 15 days or so for when is the check written. And that's really 10 and 15 days. That gives me a little bit of slippage time to total that 30.
Yeah.
And as you'll hear in just a second as well, is in dealing, as Debbie is one of our clients, and what you'll hear about is kind of the time duration that she went through. So we started talking originally, I believe, in March or so, and then really came back to the table and engaged in June when they were ready to move on the transaction. And so you can't really count that initial time period up front. We weren't really doing anything. We were just waiting for all the ducks to get in a row and then engaged in financing. So short answer, 30 days.
Wow, I had no idea that it could be done that fast. That's amazing. Maybe you should tackle healthcare. Debbie, tell us a little bit about the timing to finance your internal succession. I mean, obviously you worked with Jason and Live Oak Bank.
Yes, it happened very quickly, thank goodness, because it is a pretty stressful time. But as Jason said, I was introduced to him back in March of this year through Fidelity. My relationship manager introduced me to Jason. And at the time, I was going to make Keith an offer, which I did, but he didn't like the offer at that time. And then in June, the rubber kind of hit the road, and he threw out a number to me, said I had a week to tell him whether I was going to do it or not. So I called Jason right away, got him on the phone, gave him the numbers, gave him some background. One of the questions he asked is who has the relationship with the client. And in our firm's case, it wasn't Keith's book of business and my book of business. We knew all our clients together. So I felt pretty comfortable that, I own the relationship there. Yeah. Jason sent me all the forms, and I was approved in about 10 days, got the commitment letter. I think it actually shocked my partner, Keith. I don't think he ever
right. It's remarkable.
We closed in about 6 weeks, and part of the problem on my end is our buy-sell agreement. Keith and I went back and forth a little bit on the buy-sell, so that took a little longer. But just getting the commitment letter from Live Oak was awesome. In fact, Jason called me on a Friday afternoon, at 4 o'clock to give me the news. So I had a great weekend after that. So.
No doubt. God, that's fabulous. That's fabulous. Dave, at what point in the process should a buyer and seller begin the deal terms discussion? Is that the stage when the relationship goes from dating to engagement?
Yeah, that's probably a good way to think about it. The first stage when you're actually starting to collaborate with someone is to have very strategic discussions. You want to understand, have great clarity on what your goals and objectives are. You want to gain clarity on what their goals and objectives are. You also want to get deal killers on the table as soon as possible. I only have so much money to spend. I have this down payment requirement. I have this valuation requirement. I need Lisa or Bob to have a job for 2 years. Whatever the deal killers are, you want them up front. But as you start to navigate the strategic benefits of this combined organization and you get serious, you want to start talking about deal structure at that time. So
okay.
The ideal, you'll be drafting a letter of intent is what it would be called, and that's the time where you start saying, hey, this makes a lot of sense. What sort of valuation range do you think is appropriate? The traditional deal structure is this. Does that resonate with you, or do you need something different? Right. And how are we going to finance it? So I'd say probably by the 5th or 6th meeting if appropriate.
Very good, very good. Nice to have sort of a template to know how to gauge it. So we are on to our next polling question. You guys, let me just go ahead and launch that for us. So come to your front screen. Which type of deal structure do you think is the most common? A percentage down plus a seller finance note with a crawlback, all cash up front, stock redemption, or 100% financing. So we will give you just a second to vote on that. We have a little over a third of you have already voted already. Thank you so much for being responsive so quickly. Now, Debbie, yours was 100% financed or note down?
Yes.
Or
100% financed.
Yeah, which is tremendous. And I think that obviously they were joint clients all the way through. So that's it's probably pretty unusual to have that structure.
Right. I was willing to take that risk because I felt like I had a good chance of, keeping all the clients.
Right, right. No, that's fun. That's awesome. So we have 68% have voted. We'll give you just a couple more seconds here. Try and keep it to a minute of having the poll open. Okay, we're going to close the poll. So 94% of you said a percentage down plus a seller finance note with a crawlback. 2% all cash up front. 0% said stock redemption, and 4% said 100% financing. And that's from 69% of you voting on that answer. So, Jason, you would be a great person to turn to at this time. What are your thoughts on these polling results, and which type of deal structure do you encounter most, or do you propose most frequently?
Yeah, I think I would say that a very high percentage is a percent down supported by a seller note.
So
I think
our audience is correct. 94% picked that. So.
Yeah, and we like that. As a lender, we don't try to encourage folks and try to get a big loan and say, hey, let's do the 100% all the time. We want it to make sense. We're in it for the long haul. We own the loan, so our loans, as we'll talk about in a little bit, they're 10-year term loans. We'll be there and we want the successful transaction. We see that said, we see everything kind of across the board. I think, Marianne, is there a slide on this one here?
There is. Let me bring that up for you. There you go.
Just so I don't want to read it to everyone, but
no, that's all right. So why don't you tell us about Live Oak Bank now, Jason, if you would be so kind, and Live Oak's focus on funding investment advisors. It's just a tremendous work that you guys are doing. This is phenomenal.
Yeah, and just to round out that, I think from how I took the question of the stock redemption being kind of a smaller percentage, it's the stock redemption. We typically will see that in an internal transaction where a few juniors are buying out a senior or something like that, and that's where we'll see just to retire those shares, and every one of the borrowers moves up in like-for-like fashion in terms of ownership percentage of the firm. So.
Yeah.
We do a lot of these trends for external things we're seeing across the board right now of buying a bunch of small firms versus very large buyout books and things like that. Strategic acquisitions in different geographies, and we try to hedge things of lowering repapering of end clients and things like that. Is all those risk mitigants that we can put in there. And I think that kind of leads up to the Live Oak Bank, which I believe might be your next slide.
Okay, there we are.
Yeah, okay, so Live Oak Bank, we are a bank, FDIC insured, national footprint. We've been in business since 2007. We don't have offices, branches, checking account, savings account. We have one building in Wilmington, North Carolina, and we only lend. We only lend in very specific industries, as listed on the slide here. We do push the SBA programs because they are very affordable and with the long terms and things associated with that program. We are a cash flow lender that I'll get into in a little bit. We are tracking now at actually number 2 largest SBA lender in the country with about 1,500 loans, and we're going to come in at a little over that $500 million goal that we had, which is a good thing. We started this investment advisory vertical, as we call our industry focuses, at the end of last year formally, and we kicked it off this year. So Live Oak hires folks from the industry that understand the industry, can talk the same language as advisors and use the same acronyms and things like that. And as Marion introduced, I came from industry, have spent a good amount of time and actually specifically have been lending in the industry. So everyone on another nice factor is everyone on our team only deals with Live Oak with investment advisory loans. We bring people like myself from industry with Series 7s and 63s and life and health and understand your businesses and have been in, and actually some of our staff have actually been advisors. So we only deal with investment advisory loans. That's what we see day in and day out, from our loan officers to our underwriters to our closers. So we're very familiar with all the different types of transactions going on. We get very familiar with the cash flow nature of your business and your revenue streams. No one at Live Oak gets commissions or anything like that, so we become very consultative. As Debbie kind of mentioned, we had a few good conversations in March, and she knew where to call when it was time to call, and we did that, and it worked out just fine. So I think we can move on to the next slide. Is kind of how does Live Oak do it, if you will. So we are a cash flow lender. We're looking at those revenue streams, those consistent revenue streams from your fee-based business. If it is, we will look at some commission-based business if it's recurring and ongoing. And none of our loans have performance covenants associated with them, so there's no performance criteria. The only thing you have to do is pay your loan back. That said, we take great pride and invest a tremendous amount of money in our relationship managers that manage the clients and the loans post-closing for that, as I said, 10-year duration. We don't have prepayment penalties on our loans, and as you guys know, the payback of your loan should be the investment that you're making. So typically you'll find that will expire on the positive side a lot shorter than your 10-year duration of the loan. So that's a good thing. So we have a lot of different purposes of why we lend, from, and I just call it logical business life cycle, of startup to operating to expansion to acquisition to succession, however, whatever form or fashion that may take. We provided a lot of capital in the recruitment of wirehouse advisors that are joining your platform, and we know that expansion kind of strategy, if you will, and we look to finance those. And as Dave mentioned earlier in the conversation about the mergers and just activity from that point, merger doesn't typically have a large money transaction. It's more of a way to go. It makes transactional sense, makes operational efficiency sense, and that's great. And folks that he mentioned, Beacon Point, Aspirian, et cetera, or those folks that are expanding that way, as we all know, the larger the firm, typically the higher the value in terms of a multiple I speak from. One interesting trend that we're seeing is that advisors, we do corporate real estate loans, so commercial real estate. We have 25-year terms on those. And it's interesting, we've seen that it's actually being executed somewhat of a retirement strategy for a lot of the folks, to where they'll buy the building now with the strategy of leasing that back to the next gen after X amount of years, and they see that as somewhat of an annuity payment, if you will, collateralized by the real estate. So we've seen a lot of a few deals like that as well. And I don't know if that's a trend, but it is something that's popped on our radar, something to push more than we thought we really would, because typically it's leased office spaces and things like that. So it's kind of the Live Oak story and Live Oak products and purposes.
Well, that's awesome. So now, Jason, you've got a couple of questions in here, and we'll circle back to them. I just want the audience to know we see the questions, and we will come back to those in just a little bit. But I appreciate it, and I know they're there. That's tremendous service that Live Oak is providing the community. It's just awesome. Thank you. So now we're up to our last polling question, and this is it. At Bob Very's recent Insider Forum conference, the topic of founder syndrome was discussed. The syndrome addresses the challenges the founder faces regarding firm valuations, giving up control, and also often associating the firm with the owner's own identity or partial owner's own identity. So the polling questions: are you likely to be impacted by founder syndrome as either a buyer or a seller? So we will be open here for a little bit more, so bring it to the front tab. And I will just tell you, as people are voting here, we've got in the self-assessment checklist, I think people are being very, very honest. And it's very difficult when you put your entrepreneurial energy and ownership into a business to make that transition. I think many of us have complete understanding of what that's like and the challenges that presents. And yet we all, as business owners, want our business and our clients to have an ongoing, enduring experience, obviously with their investment care and the consistency of client care. We're going to go ahead and close the poll. So 76% of you said yes, you would likely be impacted by founder syndrome. So Debbie, this sort of brings us to your case study, if you will. Tell us about Carpenter Claydon Advisors and the challenges you faced with your internal succession.
Sure. About 2 years ago, Keith and I started talking about succession planning. He was in his early to mid-60s at the time. I'm about 20 years younger than him. Of course, he wanted to monetize the practice. And so he made me an offer actually a couple years ago, 1.5 times revenue. But in addition to that, he wanted to stay on as an employee for 3 years, making a 6-figure salary. And so at the time, the economics didn't work for me, and so we kind of dropped that and went about our business. We then reached out to our centers of influences, our CPA friends, our attorney friends, asking them if they knew of somebody that could possibly join CCA. And we did talk to a couple folks, but nothing materialized there either. So last fall, I think this is really what got the ball moving. Last fall, we were approached by a national CPA firm, and they're located in Minneapolis. They do have a presence here in Orlando. They have a wealth advisor division, and they wanted to, have a local presence at their firm here and a footprint in Orlando. So we started talking to them, and bottom line is we would be an employee, we would be paid a salary, and the way they wanted to buy our stock out was really over a deferred comp arrangement. So this didn't, sit well with either Keith or myself, so we didn't pursue that any further. And it kind of was at that point in time that I stressed to Keith that I didn't want to be an employee of a firm. I did that, didn't want to go back there, and I really just, wanted to maintain independence. So in March of this year, I made him an offer, and it was the deal structure that everyone, sees most often with a deal. I made him an offer of 30% down, 5-year note with a clawback, and he didn't like the terms of that at all. So that fell apart. So then our Fidelity relationship manager introduced us to a firm out of Atlanta. And so the first thing they told us to do was to get an appraisal. So that's what we did. We went out and got an appraisal of the practice, talked to them for a little bit, and bottom line with them, they wanted to buy our individual practice. They didn't want the retirement plan practice. So that deal didn't work. So then again, our Fidelity relationship manager introduced us to United Capital, and David referred to them earlier, and some of you on the call may be familiar with United Capital. And basically what they want to do is buy some of your stream of revenue at a multiple, and then they support you on the operations side. But bottom line there, you become an employee of United Capital. So it was at this point in time that I approached Keith and I said, I think we're losing sight of what we're trying to accomplish here. What I was trying to accomplish is when he retires, how do I replace him? And now in his mind, he's just looking for a big paycheck. So we unfortunately started getting into some heated discussions about the direction to take. And in a heated discussion, he threw out this number, which basically was our appraisal value. But the appraisal value was based on the 30% down, the 5-year note structure. But he threw out a number. He says, if you give me this number, I'm out of here, and you have a week to tell me.
Wow.
So then that's when I got on the phone. I was going on vacation, too. It was like, oh, my goodness. Got Jason on the phone, and he just made me feel so much better when I, again, gave him the deal structure. And I think what helped me in my case, as his slide showed, is that I'm 40% owner. So with a 100% finance deal, I have 60% of the cash flow to, support my loan.
Right.
And it's a 10-year loan, so and I can pay it off early if I want. So I have that flexibility. But it's a 10-year note. I can support it out of cash flow.
Yeah.
So we closed on August 12th, and it's been great. I've had lots of positive conversations with clients. I didn't know, how they would feel, but I actually, was pleasantly surprised, retained everyone.
100% retention. Well, and you had said that it's, you were both serving all the clients, so that's like the perfect scenario for, buying out the other 60% of your firm.
Exactly. It really just shows that this is a relationship business.
That's right.
So, so Keith is out here, and I have a colleague of mine who I've known for about 17 years. He has a similar practice, and we've talked about merging in the past, but what we decided to do is that we're going to kind of cohabitate.
Right.
Space, kind of date, and kind of introduce best practices of each firm, and go from there. So, but
and he would potentially be a partner in the firm.
But again, I want to thank Live Oak. It's been great. I felt like I was buying my independence because even Keith said if my deal didn't go through, he wanted to pursue United Capital. So I was willing to step up and buy my independence.
And Live Oak came to the rescue. And that's tremendous, Debbie. And congratulations on being 100% owner and to looking at bringing in another advisor. I think that's absolutely the way to do it, and doing that step by step is also smart. With someone that you've known, comparing best practices, aligning the businesses, maybe parallel for a little while, and then go from there.
Yeah, very excited. So
that's awesome. So, Dave, do you see in these deals? Do you see that? I want to go back to the deal structure. Just a quick second. Do you see deal structures like Debbie's, or what is the deal structure you see most often?
Yeah, the most traditional deal structure is, well, we should start by giving the audience kudos. They got an A+.
Yeah, they did.
Was correct. The traditional deal structure for this industry, and granted there's variations on the theme, but the structure we see the most is 25% down, the rest paid out over the course of 5 years. It's generally seller financed. We even see, prime plus 150 basis points. And as part of that, too, there's owner's compensation. So that's the traditional deal structure. And actually, when we part of our business is valuing organizations.
Right.
And we have sort of a small, medium, and large, a $5,000, $10,000, or $15,000 valuation. All of them are based on discounted cash flows, but all of them are also based on that traditional deal structure. So if you are valuing a firm, and let's say it's worth $2 million based on a traditional deal structure, if the buyer requires or asks for, say, 40 or 50% down, and the seller has the ability to pay that, and that's where Live Oak can come in as well, then it's appropriate to say, sure, we can do $2 million with a traditional deal structure, or if you want 40% down, we can accomplish that, but we're going to, the new price should be 1.83 or whatever the math is behind. And as you're migrating risk from buyer to seller, the value of the asset is going to decrease and vice versa. Similarly, if you have a 10-year payout rather than a 5-year, it's appropriate to ask for a lower price. So in some cases, you can see the value of a Live Oak or some other lending facility coming in to enable all the people to achieve their goals and objectives, which is paramount.
Right.
But it can also provide the buyer with some leverage to drive down the price appropriately.
Right. That's very good insight. Jason, when you and I were talking before the webinar a week or so ago, you were talking about potentially refinancing existing loans in people's businesses. So if someone had done a buyout, let's say, the traditional deal structure, the 25% down, 5-year payback, is that something that you could offer refinancing on, or that Live Oak could offer refinancing on?
Yeah, so we offer refinancing if we can better the cash flow of the entity at a particular multiple, which typically we can, because we're, again, as Dave mentioned, if historically deals were 5-year financing, with a 10-year financing, we can significantly improve that cash flow of the business.
Absolutely.
And then also, as people are executing along these, maybe they're 2 or 3 years into that, and they decided they're just ready to be out, and can we cash them out? The owner's not really involved, and he's fine to be paid out as well. So we have folks that are kind of in flight, if you will, and they'll call and inquire about just expediting that buyout, and we do that as well.
Very good. Very good. One quick question, and I apologize if you spoke to it directly, Jason. What would you say your target market is? What size RIA is your target market, or is that quite broad?
Well, it's quite broad, and it has to do with how the financing is going to be done, right? So we have particular lending limits and minimums for that reason. I would say our target is anywhere between 50 and 500 million in AUM, and I say that because as the common theme we've been talking about, it's not typically 100% financing.
Right.
Even in Debbie's case, she had 40% equity in the institution anyway. So we're dealing with a $14 million transaction where the broker-dealer is throwing in some money. We're throwing in about $3 million. There's a seller note component to it. So we'll do all types of forms and fashions. So it's not necessarily like really a size, but it's more size plus what does the transaction look like. Right.
Well, a couple of questions I want to answer from the audience or put forth to you. So one, William asks, what type of dealer equity does Live Oak ask for? So in Debbie's case, it was, she already had 40% down. what type of equity are you looking for?
Yeah, it's not really the type of equity. It's we can provide 100% financing, which, as we've been talking, it typically doesn't happen when a particular threshold of current equity is there. So in the obvious case in this, Debbie had 40%. She's buying 60%. We could finance 100%. If the owner, and not even, I won't even say internal or external transaction, but it's percentage-based wise. So if there is 0% current equity or managed clients or revenue stream, we can finance up to 75% of the transaction, and then typically they'll do a 2-year seller note. But that typically doesn't even happen. It's more of, okay, that's great. We'll take 50%, and then they want to seller finance the rest to keep seller skin in the game, which mitigates our risk as well. So
that's right. It's actually a good idea.
Yeah, so it's kind of situational, but no. The short answer is there is no equity requirement.
Okay. So William, I'm sure you got that. So Sakar has a question. Does Live Oak also help with finding sellers?
No, other than we don't have kind of a listed source. I would refer them probably back to you, Marianne.
Thank you so much. That was honestly I didn't put that question in there. That was really written in. Thank you.
No, I saw that coming across. I don't. Other than obviously we may get some points that are sellers that are interested, and they'll call us directly and say, can you lend? How does it work, et cetera. But then we would more refer to an institution like RIA Match, because that's not really the business that we're into.
Okay. Thank you very much. Do you do your own business valuation or accept CPA's valuation, also from the same audience member?
We do not do our own valuations. There's a conflict of interest with that. We would rely on sources that we have a short list of folks that specialize in this industry, like DeVoe, for example, that we deal with and prefer that those valuations be done on behalf. They are done on behalf of the bank, but the bank does not perform them.
Okay. One other question here was so the ballpark cost of debt financing. So we know we've talked about terms and percentages down, but what sort of percentages on those notes?
Right now we're at prime plus 2, prime plus 175, and it goes up from there.
Okay, 175 to 200 basis points. Okay, good, Michael. That was your question. Yep. Paul asks, will Live Oak Bank finance recruiter fees?
Yeah, I saw that one come across. I guess I'd suggest, Paul, feel free to reach out. I'm not sure how to answer that. What we do is anytime we're getting ready to finance a transaction, we kind of ask for the project list. What is it that you're asking for financing for? And if that's something that's going to enhance your business and there's a correlation to increased revenues and things like that, then that's fine. If you're going to hire an associate to be on your platform to support clients and things like that, and you can afford it and that gets back to the cash flow nature of our lending. If you can afford it, meaning if your debt passes our debt service coverage ratios, then that's fine and that's more of a operating capital, working capital perspective.
Thank you. And Jason, it's very good that you mentioned that Live Oak has a veterinary vertical, because there's actually an audience member that has a lead for you that I will, if you can't see that, I will make sure that you get it. Thank you very much for sending that. I know Live Oak appreciates, you never know who you're talking to, right, when you're presenting.
That's great.
So a question from Stephen. How does a percentage down with clawback work?
Who do you want to take that, Marianne?
Well, we'll give you a break. Have a sip of water. Dave, want to take that one?
Yeah. So there's different ways to define clawbacks, but the key way is it's the ability for a seller to capitalize on the appreciation of the firm above the price that they sold it to a given buyer to, if they sell the firm at a higher price several years out. So, Mary Ann buys an organization. She's a junior partner. She buys out the senior partners at $1 million. there can be a clawback provision that says that if she turns around and sells that organization within 5 years at more than a 6% increase in the value of the firm over that period, the senior partner, the exiting partner, could claw back and benefit from that. And you can see the objective. In many cases, the exiting partner is selling the firm to a junior person because they want to keep it independent. They want to ensure that their clients have that good experience, and they could have probably gone out to market and sold externally at a premium. And it's a way to say, hey, we really want to keep this in-house, and if you do that, then we want to benefit as well.
So that's a very good point, that usually internal successions, Dave, they usually are at a significant discount to market rate, aren't they?
Yeah, we see, we've done 34 valuations over the course of the last 2 years, and many of those have been internal. Generally, we see about a 0 to 50% discount to what the external market would be. It's clustered pretty closely around 20 to 25% discount. Mm-hmm. There's some scientific, or I should say mathematical, economic reasons for that discount in some cases, but the other component, of course, is emotional. And people say, I'm going to discount it to my staff because blood, sweat, and tears, or I want to have this for my clients, et cetera. So it's a mix.
Right. And that actually makes the clawback seem very fair. It doesn't sound draconian when you phrase it that way. Mm-hmm, mm-hmm. That makes sense.
Some people use the word clawback when they mean, there's a lot of misnomers out there. They use the word clawback, which is a misnomer, for something closer to an earnout, which is also a misnomer. So just to be clear, it's not uncommon for someone to buy a firm and say, okay, you know what, your organization, if we retain, let's say, 95% of the clients or the revenues generated by those clients, we're willing to pay you $1 million. Generally, a technique is to take a snapshot of those clients. You look at those clients a year later. If it's 95%, then it's still $1 million. If it dropped to 82%, then the company gets discounted appropriately because the buyer only wants to pay for those assets that come over. So that's not technically what a clawback is, but sometimes people use that inadvertently to try to articulate that concept.
Right, right. Downside protection as well as upside opportunity.
Yeah.
That used both ways.
Part of the deal.
Yeah, I see that. Okay. Thank you very much. Let me just look at these questions here just 1 second. So Paul has asked the question, and Jason, this would be for you. Will Live Oak Bank finance purchasing a wirehouse book to transition to an RIA? That's a great question, Paul. Thank you. Jason?
Yes. So just to be clear, if a wirehouse broker is looking to leave and, in this case, become an employee of the advisory firm, we would finance that acquisition. There's a difference between are they purchasing it and the advisor is leaving, or kind of what's going on with it. So we do finance, I guess at a high level, we do finance kind of wirehouse to RIA transactions is how I would answer that. Okay.
Okay. But obviously each case, you've got to take it case by case.
Yeah, because and it's worth a conversation, and if that's a part of an kind of operational strategy for growth. Is it really that the advisor is kind of disappearing and you're actually purchasing those assets, or is the person going to stay on, and is that more of a merger, and does it make sense for a big buyout transaction? Things like that. So I'd kind of have to know a little bit more about the transaction. Right, right. Sort of buying the book versus buying the practice kind of thing, huh? That sort of thing, and as we know, the practice isn't really worth very much because there's no assets. But if you're buying the book, that's where the value comes in. Right, right. And there's some nomenclature there too. Sometimes people talk about the practice as the book and the advisor and the whole picture. So I've got some SBA questions from Don and also then from Lee. So is a personal guarantee needed, including primary residence for SBA loans? And number 2, does the spouse need to sign the note if they're not in the business? The spouse does not need to sign the note if they're not in the business. The only people that need to sign the note is if you're greater than 20% ownership equity of the entity. From the personal guarantee, yes. When I was lending at Schwab, they required personal guarantees.
Yeah.
When any type of cash flow lending that I've ever heard of requires personal guarantees. Taking the house is situational. I think that we do have requirements that we have to follow, and it has to do with the equity that you currently have in your house.
Mm-hmm.
And that is also included in the HELOC that's associated with that house. And it has to do with if you're actually not in a homestead state. So I think we end up taking a very small percentage of houses in the deals that we do.
Right. Very good. A couple more questions because we're coming up on our 1 hour time. But as a lender, what do you require? Do you require non-solicitation non-competes? And that Charlie asked that question.
Whether we require them is one thing, but typically they're always in the buy-sell agreements. So it's buyer protection to have them in there, and a high percentage that we would see will be in there. It's us understanding what the transaction looks like. If it's a New Jersey advisor and the seller's moving to Florida, we've seen that there is actually mileage non-compete, non-solicits within there, within 100 miles of an institution or something like that.
Right.
So it is protection on our side, but really it's less of us enforcing it and more of them already having it in it.
And Dave, what's your thought on the non-solicitation non-compete? Standard operating procedure?
Oh yeah, it's so important to have those in place. As a matter of fact, when we do valuations, we use a discounted cash flow model for 85% of the valuation, and then to a lesser degree we'll have a multiple of cash flow, and to a tiny degree a multiple of revenue. It's only 3% of the valuation because it's such a blunt instrument. But with a discounted cash flow, there's something called a discount rate that measures the risk of the transaction. And we have 28 different variables that go into calculating that risk. And one of those is non-competes, non-solicits. If you don't have non-competes, non-solicits, you can imagine that's risk for that transaction. In the 10 years that I've been doing this, there's only been a handful, and fortunately most people have these in place, that there's deals done where you sign on the dotted line, there's no non-solicit or non-compete, and 2 weeks later an advisor leaves and takes 40 or 60% of the assets. So it's good to have as your business, as a good business practice, whether or not you plan to sell the organization, but it also indicates to the marketplace that you're disciplined and running your organization like an institution. Right, right. I think that, once people look at it, they realize that's just a must-have when they're going forward. So I want to thank you all very much for attending our webinar. We had tremendous turnout. I want to thank the panelists. You've been very, very informative, very valuable. We'd like to encourage the audience to visit RIA Match store. We've got many solutions in the store, such as firm valuation services offered by DeVoe and Associates. So be sure and check that out. Lots of free items in the store, too. So if you're looking at trying to determine, are you ready to grow your practice? There's some free worksheets from a number of different companies, Fidelity, David DeVoe. We've got quite a good number of resources. We want to give you the tools you need in order to grow your practice, solutions for succession and growth. But thank you to our audience for taking the time to join us today to learn more about financing, acquisition, and succession. And again, Jason, David, and Debbie, thank you so much again for joining us. We wish you all the best. We wish you continued success. Good afternoon. Thank you very much, guys.